Something smart this morning. I love it when that happens. It's rare, but boy, when it does, it's magic, isn't it? Um, a small class so far. Maybe everybody's got plans for the weekend. Maybe everybody's off to do things, or they're just trading. Who knows? It'll fill up. It always does. Mark is caffeinated, well rested, ready to go. Um, Fighting allergies today. Oh my gosh. All my LASIK is for nothing today. You guys are blurry. It is too flippin' cold. I agree. We're like 30 degrees here, which is actually warmer than it has been in the mornings. 17. It's just horrible. It's all right. We'll be 75 on Monday or Tuesday next week. 75 and sunny. So got the golf clubs in waiting. They can't wait to go. So we'll see. All right, guys, let's do today. Let's get through Friday, start our weekend, go live some life, right? Um, every morning, news. Checking news. My buddy sent me a message today. Man, that news was a dud. And I was like, what news was a dud? And he goes, the Canadian news. I'm like, dude, you're not trading Canadian markets. So every morning we're going to forexfactory.com/calendar and we're looking at the US markets because that's what you guys are trading. Now, if you are trading Canadian dollar versus US, it might make sense. If you are trading the German Deutsch or whatever it's called, you may want to. Yeah, go ahead. Ask a question, Kev. But I'm coming here and I'm looking for news. I'm looking for high impact news that might affect the way the market moves. It might make it too fast. It might make it reverse. It might make it spike. Anytime there is a high impact, and at 9:45 we've got two of them, it can create a problem. So I look out for it. That's it. My whole trading plan says don't trade into news. And then we're good. 22 in North Carolina. That's no good. And then everything that we talk about each and every day, all the answers, everything, comes from the Nexgen page. I don't see any. Do I have new people in here today? Maybe not. Maybe I scared them off yesterday. That stinks. Everything. On the chart, all the fibs that don't extend over to the right. Can I explain? Yeah, that's every chart though, Cav. That's not just NASDAQ. There are 3 time frames on your large chart, always. This is just how the software is written in, how everything is set up. So the skinny fibs that don't go to the right, those are from your entry chart. Those are from your smallest time frame. On the NASDAQ, it would be the 13.2. The ones that look the exact same but extend all the way to the right, that's going to be native to your large chart. So on the NASDAQ, that's the 34.5. And then the big fat ones, those are from one up. So on the NASDAQ, that's a 55.8 fib. But it's the same concept. It's on crude oil or the S&P. It is 5.1, 21, 13. On the NASDAQ, it is 13, 34, 55. Cool? But they all have the same value. They are all an area where decisions may be made. And Cav, I want you to see this. The higher time frame stopped the market there. The lower time frame stopped the market here. The native time frame stopped it here. So don't rank them. Don't make one more important than the other. Every time you've got a fib, it's important. Does that make sense? And let me give you this picture. Not that my explanation wasn't perfect and you'll never wonder again for the rest of your life, but there's the picture just in case you forget. I hope that answered it for you. If there was something else, let me know. So, Cav, pay attention when we talk about termination conditions today. And what you'll recognize is that I don't differentiate between the size of the fibs. I don't rank a fib more important than a 1-to-1, and I don't rank a 1-to-1 more important than a divergence high or low. So hang out during termination conditions, and I'll make sure you have 100% clarity. But I don't want to jump ahead of the classroom because, you know, some people don't know how to gauge momentum first. So I got you, Cab. No worries. And just, you know the rules. If I don't answer your question, keep asking the same question. I'll get there, I promise. Sometimes it takes me a time or two. We're going to look at the Nexgen website, specifically the trading guide. Because the trading guide is where everything is. The trading guide is where the trading plan is. Talking about every indicator, talking about momentum and termination conditions and entries, understanding trade management. For you guys that want to add in that next chart, the market flow chart, there's a lot of it in here. Swing trading, crypto, all this stuff that you can do with the Nexgen software. What we're going to focus on for an entire hour, maybe less, who knows, it's Friday, is the high probability trade, guys. And this is the one where each indicator on every chart agrees for the trade. This is the high probability trend trade that we talk about every morning. This is the trade that typically wins 70 to 80% of the time. And most importantly, guys, this high probability trend trade, it's just going to teach you to read your indicators. And that's exactly what Cav is saying. Cav's like, I'm having trouble understanding clear path. So what we're going to talk about, hey, good afternoon, Miss Jen. What we're going to talk about is how we can read our indicators and understand if the advantages are there. And even more importantly, if the advantages are not. So chart reading indicators is about 90% of your day. There's a lot of waiting in day trading. There's a lot of sitting still. There's a lot of wishing you were in the market when you don't have the advantages to be in the market. And then 10% is actually entering, actively trading. So what we're going to do is we're going to learn to read a couple indicators. We're going to be able to understand where the market is likely to continue, use that for an entry. We'll be able to understand where the market is likely to go and use that for targets. And then ultimately we'll understand where the market is likely to stop. And Cab, that's what you're working on right now, is where it's likely to stop and understanding when that path is clear. So we're going to do it with 3 rules, guys. That's it. I'm not smart enough to make it more complex, so we're going to keep it as basic as we possibly can. Each rule for the high probability trend trade provides an advantage when that rule is true. So large chart, and let's have strong trigger lines. If that's true, you have the advantage of momentum. I want you guys to start talking out loud when you look at your charts. I have this advantage. This advantage is in play. I don't have this advantage. And what you'll find is that you'll be able to use these rules and then take these advantages to create a trade. And once you understand the first two, once you can define momentum, once you can come up with that clear path, guys, that's it. That's the core, and that's the foundation. So while we're going to take it to a third rule and define the entry for the highest probability trend trade, I'm telling you right now that once you understand momentum and clear path, once you're comfortable with these two, it's going to open a lot of doors for you. You're going to see more patterns. You're going to be able to find more trades. These 3 rules happen on only 2 charts. Your first 2 rules are on the large chart. Even more specifically, they are on the first bar printing of the large chart. That's all you need to define the first 2 rules. Because your large chart's a very slow moving chart. It's a broad stroke of a brush. And it will define the direction, the momentum, and the areas in the market. Guys, this one leads the way. This one tells you if it's time to go to the small chart. When rules 1 and 2 are in play, when they're true, you'll go to a smaller, faster chart. The smaller, faster chart is just a refinement chart. It's taking those big, slow advantages, momentum, clear path, and then we're going to refine it. You're going to see about 15 to 30 bars on the small chart, and all it is the inner workings of that one bar. And by using the small chart, you're going to be able to pinpoint the best of the best spot for entry, where the market is most likely to continue. This is going to allow you to reduce risk and maximize profits. And that's rule number 3. Rule number 3 is just an entry rule to get you in where the market is most likely to continue. Morning, Jeffrey. We use these 2 charts because the large chart's the big crowd, guys. These are the people that move the market, that create trends, that establish momentum, that react at areas. And the large chart should lead the way. The large crowd should lead the way. Your path of least resistance is trading with these guys and gals instead of trading against them. We love it. They will define direction, momentum, and they will react at those key areas on your large chart. There is a small crowd, and the small crowd fights the large crowd. When the large crowd says up, the small crowd says down, and vice versa. The great thing is even though the small crowd has the ability to create what we call a retracement or a pullback in the market, they fail about 70 to 80% of the time because of the overwhelming strength of the large crowd. Rule number 3 is designed to pinpoint where their failure is most likely to happen. This becomes your entry for the highest probability trend trade. And if your small crowd is failing 70 to 80% of the time, well, then you've got the potential to win 70 to 80% of the time, getting in where their failure is most imminent. So 2 charts, that's it. 3 rules, that's it. We're going to keep it simple. And what you're going to find, and this is the English Lit major in me coming out, is that language is so important when you're defining things, because language is going to correlate with what you see, and that's what's going to identify your advantages. So I want you to pay attention to language today. We're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. This is my first hour of every classroom, giving these very basics, breaking them down, putting them in front of you, how to identify them, how to study them, what they mean to you in terms of advantages, and what it means to you in terms of a disadvantage when they're not present. You have the ability to simulate. So I'm starting to see some names in here that I haven't seen or that I haven't seen in a while. Simulator, guys, this is your monopoly. You're learning to become a big stakes real estate investor on a monopoly board. There is 0 risk of loss of capital. Get in there, make mistakes, break things. But the path to getting to where you want to be is every time you take a trade, post it in the room. Every time you take an entry to an exit, post it in the room. Tell me what you saw. Tell me why you did what you did. Show me on your chart your momentum and your path and your entry. And what happens is we're going to use it as an opportunity for a private session with you. You're going to get all the feedback I'm capable of giving. We're going to celebrate victories, and we're going to steer clear of challenges. And if there's challenges on your chart, I'm going to work with you and help you understand how to fix and avoid those challenges. So don't be afraid to practice, and more importantly, guys, get it in the room for that private session. We will simplify today. We're going to talk about that high probability trend trade. I'm going to give you a plan that includes that, as well as what we call a medium probability trade. And a medium probability trade is nothing more than a high probability trade with one of the advantages gone, which means that you're going to manage it a little more assertively. We're going to rely on our ability to read the indicators from these very basic lessons to know how to manage assertively. But you've got to know what you're looking for, and you've got to learn them so that they become easy. And repetition creates recognition, guys. Seeing the same thing over and over, seeing the patterns repeat themselves over and over, it's almost like it slows the market down. It's like you can almost call your shots and get a little predictive because you know what it looks like to have your rules met. That's where the second piece of becoming a confident trader ASAP comes in. Use the spreadsheet that Nexgen dropped into your Nexgen Study Picks folder when you downloaded the software. I put mine in the room every day because I steal great things from you every day and update my spreadsheet. The first tab is basic rules. This is in green what it looks like to have those 2 core rules met: strong triggers and clear path. In red is what it looks like to have them gone, to not have that advantage. And anytime your chart has one of these red looks, you're saying to yourself, wow, I don't want to be in this trade. I don't want to risk my money with weakness. I don't want to risk my money trading into an area that's likely to stop the market. So you're going to use this to create some recognition of the very basic rules individually, what they mean to you. There's the client trade section, and this is where I steal stuff from you guys. Y'all drop pictures in the room, and when you do, if they are amazing, if they're like so good and so well annotated that you could use them as a study tool, I take them and I drop them in here for the people that are coming up behind you. That's what the green section is, almost 400 pictures. This is how to pinpoint your entry on a small chart for both longs and shorts. You NASDAQ traders, there's some ideas on NASDAQ. NASDAQ moves about 10 times faster than crude oil or the S&P. And if you're going to be a NASDAQ trader, you have to know your rules and you have to be able to identify them quickly. And there's a couple little nuances that'll keep you out of trouble on that NASDAQ. I'm going to give you a very basic management plan along with a very basic entry plan. All of it is revolved around rules and if-then scenarios, but there's going to be opportunities as you become a chart reader to manage differently, more aggressively, more assertively, more casually because of so many advantages. You'll let your advantages dictate management. And then finally, there's patterns that repeat themselves. The more you study this software, the more in tune you become with these advantages, the more patterns you're going to see outside of the high probability trend trade. And you're going to use these patterns for entries, you're going to use these patterns for exits, you're going to use these patterns to just kind of relax and wait because you know what may happen because of them. And you're going to see these when chart reading becomes easy. The third tab, this is where you're going to build your plan. So in the beginning, there is one look that you're looking for. You're looking for that pattern that has been proven to win more than it loses. You're looking for the high probability trend trade. Your first 10 or 15 pictures in here should be rules met high probability trend trades. You can go take them yourself through study. When somebody in this room drops a beautiful high probability trend trade in here and I say, oh my gosh, this is the perfect trade, I'm going to steal it and put it in the client trade section. Guys, steal it. Put it in your personal trade setups. As you work on your management plan, as you begin to see patterns, all of these things, you're going to fill out your plan and hopefully make it look like the one that I've put together for you already. But you're going to do it with your pictures. And then finally is your trade tracking sheet. And I moved this to the back of it, and I don't even know why. Probably because you should probably learn the rules and then you're going to take trades. Every time you take a trade, win, lose, or draw, guys, avoid the temptation of not taking pictures of losers. Avoid the temptation of not posting losers in the room. That's where the great lessons come from. Because what happens is you're going to take a picture, you're going to annotate that picture, and there's a little link here, how to annotate for the best feedback, to get the absolute most out of me each and every day. Describe those 3 rules on every chart that you post. Talk about strong triggers. Let me know whether or not you had a clear path. And then show me your trade from entry to exit. Because there are going to be lessons in chart reads if you need them. There's going to be lessons in reducing risk if you need them. There's going to be lessons in getting more out of it. And every time you post in the room, the more information you give me, the better my feedback will be. There's also how to post in the spreadsheet, guys. You're just going to use that capture software. That's on your computer too. When you download, type in TechSmith into your search bar. You'll get the TechSmith capture software. It's there. That's how we're going to have a conversation. I want you to, on your spreadsheet, always go back to these core 2 ideas. Did I have momentum and a clear path? And then the far right is the section where you're going to take the feedback that you received and just drop it in there. You shorthand whatever you need to do. It doesn't matter. But the idea for this last tab is that this is your trade journal. And you know how they say if you don't learn history, you're doomed to repeat it? This is your history. So every morning, I want you to go back and I want you to look at what you did yesterday. I want you to look at every trade that you did and I want you to ask yourself what worked. Because the things that are working, those are the things that are probably going to work their way into your trading plan. And they will keep you relaxed and they feel easy. And then you're going to ask yourself what didn't work. And there will probably be more things that don't work in the beginning than do. Because we're going through a learning process. You're new. It's okay. Be new. But give yourself the opportunity to get feedback on everything you do as a new user. And what's going to happen is you're going to begin to focus on the things that are causing success. And you're going to begin to focus on avoiding the things that are removing that success. You'll begin to see patterns in the market. You'll begin to see patterns in yourself. But if you do this every morning, it will accelerate the learning. And guys, Finding the patterns in you is what I do. Everybody has a thing. Some of you will fight. Some of you will get in early. Some of you will jump out late. And what happens is after 4 or 5 charts from you, so I'm talking to you new users, after 4 or 5 charts from you, I'm going to have your thing figured out. And we'll talk about how to encourage you to repeat it, or how to build a plan to avoid the things that are taking troubles or creating problems for you. And you'll see it in the feedback. Indetermination, indetermination, indetermination. This is your pattern. Or maybe it's this is perfect, this is perfect, this is perfect. That's your pattern. Recognize your patterns so that you can repeat them, so you can find success. And I'm telling you, this is how you get to where you want to be. People have been doing this for 20 years with us. We've been teaching people for 30. It's just chat rooms haven't been a thing that long. This is how you're going to get to where you want to be. The people that post the most typically make the most and find success the fastest. So let's get into what we're looking at. We're just going to describe indicators so you know what it is that's on your charts. Trigger lines are on large and small charts. Trigger lines there's 2 kinds. There's the small triggers, solid lines. There's the large triggers, dashed lines. I love the saying, you don't have to be able to build a watch to tell time. You don't have to know that this is a small moving average or that is a large moving average. You don't have to know the math that goes into it. You don't have to know any of the settings to make them happen. The only thing I need you to know is the difference between the two. 2 solid lines is a small trigger. 2 solid lines is a large trigger. We're going to use these to define momentum. We're going to use these to define termination conditions. We're going to use these to define entries. So know the difference between the 2. Every chart will have areas. Areas, for the most part, are just horizontal lines. You're going to have them on a large chart and a small chart. This is just defining what they are. Divergence high lines. This is a magenta line that prints off of a pivot if there's a loss of momentum. So price goes up, price goes down. If momentum didn't follow price, you're going to see this negative number in a magenta line. All divergence means is that there was a loss of momentum. I want you to associate that word. Divergence lows are the exact same thing. Price goes down, price goes up, momentum didn't follow. This blue line prints about the 3rd bar up. This pink line prints about the 3rd bar down. That's when the calculation is done. There's going to be Fibonacci resistance. It's always the red fib. You'll see them on large charts and small charts. You'll see Fibonacci support. It's a blue line. Large chart and small chart. You're going to see yellow 1-to-1s. So yellow 1-to-1s when the market is going up are the same as this red line. They behave as resistance, the same way a divergence high may. And then at lows, yellow 1-to-1s may behave as support, the same way Fibonacci support or the cyan divergence low may. And then finally, there's the mid-band. This is a exponential moving average. I don't know what that means. What I do know is that when price is above it, it's going to be green and it may behave as support. When price is below it, it's going to be magenta and it may behave as resistance. So these are the areas. And again, depending on the chart, these areas are going to define trouble, but these areas are also going to define entries. So let's get to the rules. All you people that are brand new with me, if you have a question, just type it in the room. Hey, Mark, I need clarity. Hey, Mark, say that again. Hey, Mark, show me a different example. That one didn't click. I promise I have you. One of my happiest moments is when my first hour lasts for 2 hours because everybody needs questions answered and they're willing to ask. So let's start with the large chart, the 13-2. And the large chart needs strong trigger lines. Remember, the large chart leads the way. The large chart is going to define direction. It is going to give us momentum. It's going to establish a clear path. So let's let it define direction first. Easiest lesson that you'll ever get out of me. Green means up and red means down. Look for rules to be met going the direction of the market. If you're colorblind, send me a note. I'll show you how to circumvent this without the colors. But if it's going up, I'm going up with it. If it's going down, I'm going down with it. The trend is your friend, guys. In order to have strong triggers in an uptrend, the only way it can happen is if the small triggers and the large triggers are green, just like the background. If the trigger lines are different colors from one another, or if the trigger lines are different colors from the background, you don't have strong triggers. Your rule is not met. But in an uptrend, if your small triggers are above the large triggers, if the large triggers are wide, and then this is the one, we're going to take pictures and vandalize a little bit today. If there is space between the small and large, and I want you to get the visual of scissors that have just opened and are excited to cut, ready to get something done. When the scissors are open, whether it is going up or the background is red, the larger red, the smaller red, and the space is created, those scissors are open. Guys, those open scissors let me know that the odds are favorable for the market to continue in the direction of the trend. You're going to see it annotated on charts in this room, OFM, odds favorable momentum. This is the advantage of rule number one, and that separation, those open scissors, let me know that that advantage is in play. That advantage ends when your scissors close, when your small triggers return to the large triggers. And once I have small triggers inside of the large triggers, this is what we call a weakness, a weakening of the large triggers. And anything can happen up or down. So again, I'm talking about language today. When I have strength, strong triggers, the odds are favorable for the market to push in the direction of the trend. When I have strong triggers, that's what I need to break those key Fibonacci areas to go off to the next one. When I have strong triggers, that's when I'm going to buy or sell Fibonacci support or resistance on a smaller, faster chart. And guys, when I have strong triggers, it can even cover some of the mistakes that I'm going to make as a new user because it is very difficult to stop that momentum. When I have weakness, retracements from the middle of nowhere can happen. When I have weakness, key Fibonacci areas tend to hold. And when I have weakness, anything can happen. And that just doesn't produce a whole lot of confidence in the trade that I might be taking. So, strength or weakness, let it be one or the other. And let's go to a large chart and see if we can't define a little bit of it. Well, S&P is going a little sideways, but guys, there it is right there. Separation between the small and large is what it looks like to have strong triggers. Whoops, I'm latched onto a line there. Separation between the small and large is strength. There's the small returning, and look at the retracement. Separation is strength. Separation is strength. Smalls inside is weakness. This is where retracements happen. This is where the advantage is gone. Could you guys give me a Y in the room? If you're good with this one, this is typically a pretty easy lesson. Separation, from the point of them breaking apart until they return, this is where I'm looking to buy or sell Fibonacci support, resistance. So in a long trend, anytime I have strong triggers on the large chart, you're going to see tails or wicks form when price pushes below the midpoint of that bar. This is actually that fight from the small crowd. This is that retracement on a small chart. You'll never see the momentum change in that one bar. But know that if you see a tail or a wick, there was a potential long trade. You're going to be able to use these to go back and study this pattern historically to develop some trust in it. In a downtrend, when my scissors are open, a lot of potential opportunities. And once the scissors close, I'm just done looking. Jeff, thanks for the feedback there, Jeffrey. It's nice when at least one person says yes. Guys, I don't ask if you're good with the lesson for any reason other than if I get a no in the room, I want to go back and repeat it, and I certainly don't mind doing that. Rule number one, strong trigger lines gives me the advantage of momentum. Rule number two is going to make sure that I don't trade into anything, to make sure that I don't trade into an area that could stop the market, that could create an untradeable bounce. It's good to have you here. So guys, termination conditions false will give me room to my profit targets. When I have room to my profit targets, I'm going to say that I have a clear path. So we're going to couple momentum with a clear path, And that's going to be a day's work on the large chart. What is a termination condition? It's a Fibonacci-based indicator that may reverse the market. How easy is that? It's a horizontal line on your large chart. It may stop the market. It could create an untradeable bounce. It could break. You'll never know what the reaction is going to be, but we're going to use the trigger lines to help out a little bit. Guys, these lines on the large chart, these are where the large crowd are making decisions, where the buyers are buying, where the sellers are selling, where fights are happening, right in between these two areas. So when we talk about termination conditions, I want you to think, okay, the people that move the market are going to make a decision here. So to identify a termination condition, there's two things that have to happen. The first thing is that price reaches the area. So in this case, price reaches resistance. So that resistance could be a divergence high. It could be Fibonacci resistance, the red line, or it could be yellow one-to-ones. And when price reaches resistance, when your dynamic Renko bars go up and get to that area, the only thing that you have to do is say, hey, where are my triggers? The triggers will define. Price getting there sets off the decision-making process, and then we're done with price. It's 100% the burden of the triggers to let you know the most likely outcome. And if the triggers remain below resistance, resistance is a termination condition. And if resistance is a termination condition, rule number 2 isn't met. And if rule number 2 is not met, no trades into the area. Because when price reaches resistance and the triggers remain below, this area could create an untradeable bounce. This area could create a fight between buyers and sellers that you don't want to be a part of. This area could even reverse the market completely. And if it reverses the market completely, we're going to call it a strong top. And a strong top sets you up for the highest probability trend trade you could ever take. And a strong top also happens to be rule number 1 for at least 3 other trades that I'm thinking of off the top of my head. So when price reaches resistance, if the triggers remain below, sit on your hands, be patient. Let's see what the reaction is. It's either going to break or it's going to roll. If it rolls and heads down and reaches Fibonacci support, yellow one-to-ones, a divergence low, one of those horizontal lines, all you have to do is ask yourself, where are my triggers? And if your triggers remain above Fibonacci support is a termination condition. Absolutely no trades into that area. We're going to wait for the reaction. It's either going to reverse the market and become a strong bottom, it's going to create an untradeable bounce, it's going to fight, or it's going to break. I will never know what the reaction is going to be. But the one thing that is a gospel truth, more often than not, if price reaches an area and the triggers remain below resistance or above support, it's more likely to stop the market than it is to break. That's it. That's the advantage, is knowing exactly where the market may stop and then choosing to respect that area. Guys, this was 36 termination conditions, 6 opportunities to make money. 90% of your day is doing nothing. So this is what it looks like when it rolls. Strong top, strong bottom, terminations reversing the market. This is what it looks like if it breaks. And there's like this progression. And it always starts with price reaching the area, you saying, where are my triggers? And guys, every termination condition or every line on your large chart will be a termination condition for a moment. Sometimes it's a second, sometimes it's an hour, but when price reaches resistance and your trigger lines remain below, just wait to see what the reaction is. It's easier than trying to predict. If it's going to break, the first thing you're going to recognize is that your small triggers absolutely smash through the area. Typically 2 to 3 points is what I want to see to consider them smashing through. And as long as there is odds favorable momentum, with the smalls above, even though the large are below, this area has the potential to break. It relies on that momentum. This is what we call a 50-50 look. And this potential can be capitalized on. I'm going to give you a plan to take trend trades with the potential to break, but it's not broken yet. So you're going to need to manage a little assertively. But once your small triggers get above both lines of each, once the large triggers get above both lines of each, Guys, now resistance is broken. Now resistance behaves as support. Now your path is clear. And when your path is clear and you have momentum, you're going to look for high probability trend trade entries until you reach the next area. And once you reach the next area, the process starts again. In a downtrend, first it's a termination, then it has the potential to break. Once it's broken, we're looking for entries until we reach the next area. My path is clear. So let's see if we have any examples on a large chart. Of course we do. Fibonacci support stopped that market cold. Does everybody see it? Huge downtrend. Where did they stop? Fibonacci support damn near to the tick. You're going to learn to trust these. Market goes up, a fight ensues, trigger lines don't match. They're duking it out. The sellers weren't done. They came back down to Fibonacci support, at which point the buyer said it's time to make a decision, and that decision is that we want to go up, and that's exactly where it starts up. Weakness creates a little bit of a retracement. Support breaks, behaves as resistance. There's a great example. Resistance creates an untradeable bounce. Resistance creates an untradeable bounce. Right back to support, right back to a divergence high, right back to support. Rule number 2, keeping you out of consolidation and chop. Thank you, rule number 2. And you can see that the fight continues, guys, and that S&P has been full dukes. Right to Fibonacci resistance, once again to the tick. And that's where this downtrend has started. And if you look at the most current bar, we have odds favorable momentum, but we are directly into 1, 2, 3, 4 areas that haven't broken yet. That momentum sure is pushing through though. Guys, if you go back and do a little bit of study, there we go. Support just broke. Now it's behaving as resistance. Pretty cool, right? All the triggers are below. That's how quickly it can happen. Once you learn the very basics, is it a termination or is it a clear path? It opens the door for being able to capitalize on the potential. But there will be times, Cav, this is for you. There will be times when your path isn't clear. And it won't be clear because you're going to have area after area after area. And guys, every time you start to get through one, once price reaches the next one, guess what? The process starts over. You're back to number 1. It's a termination. There will be times when your path simply isn't clear because the areas are stacked. This is 90% of your day. And it's okay to do nothing. It's actually better to sit on your hands and do nothing than to trade into a line. The futures markets, they exchange trillions of dollars every day. About 220 billion an hour in the futures markets. You need to capture 400. 400 a day puts you in a 6-figure income based on your trading consistently every day for a trading year. So guys, when you can't seem to find that clear path, understand it's coming. It's coming when it's ready, not when you're ready. The path cleared, and now we have weak triggers right at support, and you can see the market bouncing right off that key area right in front of you. So Cav, this is a great example of when you have to be patient. And maybe this will set up your clear path a little bit. Because in this particular look, you've got a higher time frame, you've got a native time frame, you've got smaller time frames, you've got every time frame right here. And every one of these lines is important. The native time frame creates the first bounce. The higher time frame creates the second bounce. Smalls and large get above, it becomes support, but this one's only potential. And when this one finally breaks, this one's only potential, and then we hit the next one. So Cav, in this whole area, you never had a clear path because your areas were stacked. Does that make sense? And it doesn't mean that there weren't opportunities. It means that you have to say to yourself, this isn't perfect. There's an awful lot of lines I may have to manage aggressively. And what's common, and Cav, let me know if this is what you're thinking, where people will say, okay, there's my first one. And once this one breaks, they say, all right, my path is clear. Even though it's into a termination. And look how that bounce happened. Well, I had a clear path. I finally got above it. But there's a textbook termination that created a big bounce. This is your 90%. Same is true here. Same is true here. So just because this one clears, it doesn't mean that that one is automatically fair game. And just because this one clears, it doesn't mean that one is automatically fair game. Guys, this is the 90%. And it happens. That look has been beating you. And it's because you wait so long for that one to give up the fight that you want to ignore that one. But check it out, Cav. And when we go to entries, we'll look at this. This nonsense was difficult to gauge. That was your moneymaker. Your patience was rewarded with this one right here. And we'll go back and look at it when we do entries. But 90% of your day is doing nothing. 90% of your day is waiting for those advantages, guys. And the most successful traders that I work with are the ones that are capable of sitting on their hands and doing nothing. You're welcome, Cap. I hope that answered it for you. That's that patient piece. That's the patience piece. All right, so the large chart has provided me the momentum that I need to feel good about looking for termination conditions. And we're going to go to this one right here. So my large chart has momentum. And my large chart has a clear path. Do you guys see this? That's rule 1 and 2 being met. That's what it looks like on a large chart. Rule number 3 is when we let that small crowd fight. Rule number 3, we're going to wait for a pullback. And rule number 3 says that these entry rules are so precise that we're going to wait and we're going to use a limit order to buy or sell a pullback, that fight created by the small crowd. And we're going to buy or sell at an area. We're going to use fibs, midbands, and yellow 1-to-1s. The same way those areas could stop forward progress in the direction of the trend, they can also stop that small crowd's fight and create a bounce to return to the direction of the trend. But here's the key. Those areas need to be inside of triggers because triggers are where price returns. Price breaks away from large triggers, it returns to large triggers. It's the regression of the mean, math people. That's what someone told me once. And it may return to the large triggers on the small chart, and it may return to the large triggers on the large chart. So on your entry chart, you just have large triggers from both. And what these trigger lines are going to do for you, the large triggers will define where the retracement is most likely to occur, where that down push is most likely to return. So trigger lines create a range where the retracement is most likely. If you want to minimize that range, if you want to increase your accuracy, take some of the stress out, look for favorable large triggers. Because favorable large triggers mean that the large triggers and the synthetic triggers, the large triggers from both charts, are overlapping in the exact same price range, like two snakes riding piggyback, which means that you've got the smallest possible location for that retracement to return to. There's a preposition at the end of the sentence. I'm sorry. And then when you shoehorn fibs, midbands, or yellow 1-to-1s in there, you have the smallest possible window where you can say this is where the small crowd is most likely to fail. This is where the market is most likely to bounce and continue with the direction of the trend. So backing it up, rule number 3 says that we're going to use a limit order to buy or sell a pullback at an area inside of triggers. Triggers define the retracement. So when they're split, there's a little more indecision and a little less accuracy. When they're favorable, we really tighten things up and we're able to be pretty precise. So let's find an entry. Once the rules are met on the large chart, in this case, my large chart, the background is green. the triggers are strong, and the path is clear, which means that I have got 1,000 pounds of giddy up to the upside and nothing in the way to create a bounce. Your small chart is going to look like this. You should have strong triggers to the upside. And you're just going to glance and say, where are those large and synthetic triggers? Where are the areas? And guys, all you're doing is you're in a holding pattern, and you're going to feel like the world is going without you. And then you get a reversal bar. And this reversal bar is the beginning of the fight. This reversal bar sets off the pullback. And once you get the reversal bar, you're going to identify where that retracement is most likely to go. Price tends to return to the large triggers. You'll notice that I don't speak in exact terms ever. This area may reverse the market. Price tends to return to the large triggers. The market is never under any obligation to do what you want it to do, and very often it doesn't. But 10% of the time it does when the rules are true. So I've got large triggers and synthetic triggers. From the highest line of the triggers to the lowest line of the triggers is where the market is most likely to retrace. I'm designating the retracement zone. And it's a pretty big box. And the tighter those large and synthetic are on top of each other, the smaller this box becomes. But entries don't come from trigger lines. They come from areas within. I need areas inside of those triggers. I need fibs. I need mid bands. I need yellow 1-to-1s. Inside, all caps. So this much smaller box, drawn from the highest point of support, the highest area inside of triggers, to the lowest area inside of triggers, guys, this designates where the small crowd is most likely to fail. This lets me know where the market is most likely to bounce and continue with the trend. I want you to think of these areas as a brick wall and price as a tennis ball. That's where it's most likely to bounce. It's not likely to bounce before it hits that wall. You're going to study this. You're going to practice it. You're going to get feedback on everything you do, and you're going to learn to trust this pattern so much. You are going to believe wholeheartedly, with conviction, that that area is more likely to create a bounce in your favor than it is to just get run over. And you're going to activate a limit order 2 ticks above the highest area of support, because we're not going to trip over pennies to save a couple dollars, guys. And once you activate your limit order, you're done. Stand up, roll away from your desk, sit on your hands, pet the dog. You've done all you can do. That's it. And if they can push down, if that small crowd has it in them to get to your entry, you're in a long position, which means you bought the market, which means your expectation is that it's going to go up. And you have an advantage of a market where the odds are favorable for it to continue up because of those strong triggers. And you have the advantage of a clear path, giving you room to your targets because no termination conditions were present. And you have the advantage of having entered precisely where the market was most likely to continue up with the trend. This is your entry, and you'll notice that your entry is based on 3 advantages. 3 advantages create a trade. So you've got to learn how to put them together. You've got to be able to identify momentum on the large chart first, making sure that advantage is in play. You've got to be able to understand termination conditions because you don't want the market bouncing off something on that large chart. And then you've got to develop the patience to wait for the reversal bar, to start that fight. Avoid jumping into the market, new users. Just learn this one little trick. Reversal bar signals the beginning of the pullback. It's not your entry. Find your trigger lines. Define where the market is most likely to return. It's not your entry. Find the areas within those triggers, within that retracement zone. Fibs, midbands, and yellow 1-to-1s. And you're going to create a window of opportunity where the market is most likely to bounce, where the small crowd is most likely to fail. And you're going to develop the courage to activate a limit order and literally buy that market on its way down on a smaller, faster chart. And you're going to understand that anything outside of that window, anything below those triggers for a long trade, guys, that's not part of your equation. Once you get past the retracement zone and any area inside of it that could create a bounce, your advantage is gone from rule number 3. You're no longer taking a high probability trend trade. And once they get below these triggers, I don't know if or when that market is going to bounce up. In a downtrade, short market, downtrend, there we go. In a downtrend. Sorry, guys. It's Friday. It's been a week. Your large chart is red. It's screaming down and there's nothing in the way. And you're going to wait for it to go up on a smaller, faster chart. Reversal bar is not your entry. It starts the fight. Once I have the reversal bar, where's that retracement most likely to return? Up into these large triggers. But it's most likely to bounce off the area within. And guys, your window of opportunity is one line wide here. Your job is to activate a limit order 2 ticks below that line, and anything beyond the retracement zone, anything beyond the areas most likely to produce a bounce, these are not a part of the entry equation. Once I'm on the wrong side of those triggers, there is no telling if or when the market is going to continue down. Rule number 3, advantage is gone. And here's a happy little accident. Once you define where the market is most likely to continue, you understand where the market should not go. This is your initial stop placement. This is where you're going to place a protective stop, and you're going to say, if the small crowd wants my money, they are going to have to break through the retracement zone. They're going to have to break through the areas. And if they do, I don't want to be a part of that trade anymore. And 20 to 30% of the time in the high probability trend trade, that's exactly what they're going to do. Losing a trade isn't a negative when you have all the advantages in play, because all it is a pattern that's been proven to win more than it loses. You know exactly where it shouldn't go, and you've got to be willing to cut ties. And the reality is small losses are a normal part of a positive equity curve. Every 10 you take, you're likely to get your stop hit, and you don't get to pick which ones it is, which is why we're developing trust in the pattern, and we are consistently entering every time the rules are met. And this is how I think this is the easiest way to develop trust. It's not taking trades over and over, because we're all human, and losses suck. No matter how much I say they're a normal part, nobody likes taking losses, even from the right trades. But you'll learn to realize that when the advantages are in play on the large chart, your highest advantage comes from the entry on the small chart. This is your first trade, the best of the best trade, your highest probability trade. Guys, remember when we talked about those tails as being the retracement? Notice that from the top of this bar, where the reversal bar begins, all the way to the bottom of this bar, where the pullback to support was, and all the way back up towards your target, all of this happens in one bar. That's that tail. We don't wait for tails to form, we would be long gone. But because when the rules are met, we wait for a retracement, our risk is reduced. Because we get in at the areas inside of favorable large triggers, we have even more distance to our target. So I want you guys to use these tails. And I want you to be able to go back historically. I've got momentum and the potential to break. Let's see what that circle looked like on a smaller, faster chart. It looked like a pullback directly to support inside of triggers. Whoops, let's put the two together. Do you guys see it? Momentum, potential to break, pullback to support, right inside of the retracement zone. Guys, this is your pattern. This pattern repeats itself every day. This pattern repeats itself. Whoops, that's my untitled workspace. My apologies. This pattern repeats itself on every market. This is nothing more than a pattern that has been proven through study to repeat every day, to create advantages, to let you know that when there's that much momentum and the potential to break, areas in that retracement zone are most likely to stop it and create the bounce. So you're going to want to go study it. You're going to want to learn it. You're going to want to practice it. And the easiest way to get to where you want to be isn't taking trades. It's taking pictures. Whoops, that's not what I wanted. That's what I wanted. So I'm going to give you guys Chart Reading 101. Chart Reading 101, the goal is that you first look at your large chart, that you let the large chart lead the way, that you force the large chart to lead the way. Identify momentum and path. Give yourself 66% of the great things that create awesome trades. This is the core of your education, guys, and understanding these two concepts will open the door for more opportunities. You're going to see people in this room that take trades based solely on momentum and path, and don't even wait for the retracement on the smaller, faster chart. That's okay. They learn to read their indicators. So to get to where you want to be the fastest, take 25 pictures each, and you don't have to do it all in a day. Commit to 5 pictures a day of each of these. That's only 20 pictures. That's not a lot. Take the time on your chart to type out why it's strong triggers, why it's weak triggers, why it's a clear path, why it's a termination condition. Take the time on your chart to type out what the advantage of strong triggers is, what it means to you, why you want to wait for it. And what happens is you're going to post all these pictures in your spreadsheet that I gave you. And after 25 pictures of taking a picture of strong triggers and saying all green, smalls above the large, space between, odds favorable momentum, you are never going to mistake the look of momentum with the look of weakness. And you're never going to mistake a clear path with a termination condition. So we're keeping it very basic and very focused. This will get you where you want to be the fastest, and then you'll piece those advantages together to create a trade. I'm also going to give you the high probability trend trade checklist. This is the best of the best, highest chance of success, optimized way to get into the high probability trend trade. And it starts with that strong top or bottom, which isn't mandatory. This is not one of the 3 rules. This is the one that creates some warm fuzzies. When a termination with no triggers going through it, and I want you guys to see something. When I talk about no triggers going through, let me see if I can make this huge real quick. Boom. Your trigger lines are like a car. Front of your car, back of the car. This Fibonacci resistance is the brick wall you're driving into. And if you can't get both sides of your car through that area, they did not get through that area. Does that make sense, everybody? If both lines don't break through, they didn't break through. That's going to come in handy on those potential to break ones as well. So is the market coming from a strong top or bottom? A no triggers through termination that reverses the market. If it is, makes you feel better about that next trade. You have to be able to define momentum. This is the first rule. It's either strong or it's weak. There is no, I love it. People will annotate on a chart. Anything can happen, strong triggers. Weak, odds favorable momentum. Like, guys, you can't combine the two. Let it be one or the other. Keep it very black and white. It's either going to be a termination or a clear path, brand new users, and then eventually you'll start capitalizing on the potential. Know which one it is so you know how you have to manage it or if it's time to avoid it. Define your entries. Know where to put your entry. And then the second page is the actual checklist. And this checklist is designed for you to print out, to put on your desktop. And as we go into the weekend, guys, use this checklist and market replay. Pause that market replay. Make sure that your rules are met. Nobody in the history of this checklist has been able to mark yes to all 4 of these and do worse than 70%. If you're one of my brand new users, I challenge you to learn these very simple rules, put them together, and stick to it. Because the goal is to win more than you lose. The goal is to get paid. This is your highest chance of success. Print this out. Use it every day. And then I'm going to give you the KISS plan. And Chef, I love that you're in the room when I present this. The KISS plan is the stepping stone in your learning journey. The KISS plan is your first trade. It's designed to teach you to read your indicators. The KISS plan is not the only trade. The KISS plan is not... Chef. Guys, this isn't your get-rich trade. This is the one that teaches you to see your get-rich trade. And, Chef, there are people that started brand spanking new ground zero with Nexgen and got qualified in those prop firms following this plan within their first 30 days. Simplicity pays dividends. I can't say that enough. So this is a stepping stone. It's designed to optimize your chances of success. Hey, Black Prince. Nice to see you in here. Guys, this is the best of the best, the highest probability, the most successful way you can take the high probability trend trade. It's not the only one. You'll create your own plan based on your ability reading the indicators, and you're going to do that through simulation, through study, through class feedback, and continuous practice. And there's two things you need to know before you enter the market, especially if you're not on sim. And since you're brand new, I don't expect you to know these things. You're learning them. So I'm giving them to you. Why will I enter the trade? It should be, and you know what? I'm going to add this in here. Why will I enter the trade? Because my rules are met. That's the only reason to enter a trade. Because my rules are met. Because your rules are nothing more than a description of a pattern that has been proven to win more than it loses. And if you verify it, don't take my word for it, guys. You don't know me. I'm just kidding. You can take my word for it. I'm pretty trustworthy. But I want you to go back and study it. I want you to prove it. I want you to say, yes, this pattern wins more than it loses. And then there will be no reason for you to not enter if the rules are met, because you will believe this is a pattern that wins more than it loses. And your rules really will help the emotions in trading, guys. When you enter the best of the best trade, you're going to be relaxed. You're going to feel good about it. And it's probably going to be over quick. When you enter the wrong trade, you're going to know it, and your palms are going to get sweaty. And your stomach's going to turn, and you're going to start moving your stops. So focus on having your rules met as a brand new user. You will get lucky and create a little short-term victory. That typically sets up long-term failure. And then you have to know why you're going to exit the trade. And guys, exits are either taken at profit targets, that goal you have maybe at a key area, or when the advantages that you had to enter the trade have gone away. So if I enter a trade, a high probability trend trade, and 3 divergences print on my small chart, which is the termination condition, that's an exit condition before my profit targets are reached. So it's important that you understand why you're entering. We've defined it. And then what to do with that great entry. And guys, the management plan in the KISS plan is the absolutely most mechanical, pragmatic, emotionless, if-then scenario you could ever put into play as a brand new user. And it's designed to do 2 things. Trading 2 contracts. It is designed to help you understand stop placement, understanding where the market should not go, protecting your investments without moving your stops arbitrarily and chumming the waters for them to come grab you. And it's focused on getting you paid. Because that's the only reason any of us do this. Nobody's like, you know what? I don't really want the money that successful day trading has the potential to bring me. I just like video games, so I don't want to play Pac-Man anymore. Nobody does that, guys. We're in this to make money. So the KISS plan is dependent on your ability to recognize entries. That's why we talk about great entries for an entire hour. Because management becomes an if-then. If my entry is 2 ticks below resistance inside of triggers, if my entry is where the market is most likely to continue, if my entry is where the small crowd is most likely to fail, then my stop is 4 to 5 ticks beyond those trigger lines, where the market should not go. And guys, you will know your risk before you ever enter the trade. You will know exactly where your stop goes before you ever put that limit order in. So you can make the decision. Am I willing to risk that much on a trade? And here's the deal. If you're not willing to risk 15 ticks on this trade, if you say I only want to give it 5, you're setting yourself up for failure, because you'll be putting your stop where the market may retrace, not where the market should not go. Your targets in the KISS plan are predefined, $100 and $200. Let it play out, guys. And if you don't get stopped out, it means that you got a reversal bar in the direction of your trade. And this is going to redefine where the market should not go. Your new stop will be 2 ticks above that reversal bar. If it were a long trade, it would be 2 ticks below. You go from having $150 of risk per contract to only having $30 worth of risk per contract. It doesn't mean that you're going to win, but it means if you lose, it doesn't hurt nearly as bad. And guys, great entries minimize risk, and it's hard to not get that reversal bar with an outstanding entry. So now you're either going to get stopped out for a smaller loss, or it's going to go to your first target, which is only $100 in the distance. And if price reaches your first target, one contract is automatically removed. And those funds go into your account. And with one contract remaining, you're going to move your stop to break even and give yourself the confidence to hold for the second target. Remember, your large chart is screaming down with nothing in the way. We're learning to trust that large chart. And if they don't get you break even, it means that they're going to your second target. And if they go to your second target, that is a $300 trade in about 3 or 4 minutes of your life. And that's it. As a brand new user, keep it that mechanical. Don't move your stops and targets unless it's time to move your stops, and learn how to trust the plan, guys. And $300 a day, if that's the best you can do every day, is $75,000 in your trading account. That is pretty low. And anyone that spends more than 4 or 5 days in my room knows that that's low. Because you're going to see traders posting pictures all morning long, hitting 4, 5, 7, 9,000, 2,000. Hell, I had a guy post a $16,000 day in here. And he did it trading these very basic rules. Guys, it's not about finding more trades. It's about finding the best trades consistently and learning how to get paid. That's all we have focused on for an entire hour. So this is where I give you everything you need to be successful with the software. I just dropped a file that says all you need right into the chat box. Download it. Study it this weekend, guys. Inside of that file, that zip file, is the chart reading 101. Is the high probability trend trade checklist. Is the KISS plan. Is the PowerPoint that I use to teach this classroom every morning. There is 2 more in there that we didn't cover yet that I'm going to go ahead and talk about. The first one is Trend Trade Simple. And guys, this is everything that the last 50 minutes have been about, consolidated into 2 pages to keep it simple, to keep you focused on what's important as a brand new user. And then the second one is, this is the path, guys, the pictures you can take. I encourage everybody to take 15 pictures every day. These are the pictures that I take every time I take a trade. I'm 5.5 years into it. I still take a picture of every trade. I take a picture pre-trade. When I set my limit order, I don't annotate it in the moment because I'm trading. But I'm going to go back and study it and make sure my analysis is right. During the trade, every time I move a stop, every time I take profits, I'm going to take a picture. And I'm going to go back and I'm going to use these just to work on my management plan. After the trade, this is where I'm going to go back and I'm going to annotate this chart. And I'm going to talk about advantages and why I did what I did and where I did it. I'm going to be able to see it. And then finally, I'm going to take a picture when there's no trade, when my rules weren't met. Because guys, it costs less money to take a picture and talk about why you're not trading than it does to take the wrong trades. Pictures 3 and 4 are the best ones to put into the classroom, guys. Picture 3 from start to finish is where you're going to get the best feedback when you tell me why you did what you did. Picture 4 is reaffirming that rules are your lifeline, that you're going to follow those rules. But as a brand new user, people tend to make mistakes. And if you put a picture in the room, let me bring this one up. I've got pictures for everything. You guys will find that. If you come to me and you put this picture in the room and you tell me, Mark, this was no trade, that termination condition on the small chart kept me out, meaning the 1-to-1s, I have to remind you where areas are defined, and that's a large chart thing. And if you say, but Mark, the colors on my trigger lines on the small chart didn't match, I didn't have momentum, I can't take that trade, the rules aren't met, I remind you that momentum is defined on a big, slow-moving large chart, and that momentum never wavered during that pullback. So guys, sometimes your no-trade pictures are the ones that really get you focused on following rules, where you created a little misunderstanding in your brain that needed just a little bit of clarity. So you guys have that zip file, you have the spreadsheet, you have the rules. Hold on, what else do you have? You have everything. Where to go? You've got rules, you can simulate, you can get feedback, you've got a plan, you've got a spreadsheet to post it in. You have everything that you need to be successful with this software, with the exception of the repetition, of the experience, for it to become easy. And guys, the cool thing is if you are brand new to trading or if you are a seasoned trader, you're going to find a way to add value to your plan or to create a plan with value with what we have here. So whether you are new or old, whether you're experienced or a rookie, let me help you. Post in the room. Give me the opportunity to give you feedback. That's what the next 2 hours is for, guys. 100% dedicated to giving you feedback, making sure that you're reading your charts effectively, that you understand, wow, there's a lot open here. Exactly what you're looking for. So I'm going to take 5 minutes. When I come back, we're going to start looking at charts. Guys, go straight. Back to it. It's Friday. Let's have some fun. Look at this. Week, retrace, bounce, bounce, break. Pretty cool, right? And now I have momentum. And now I have the potential to break. And if I get a pullback, I could consider taking a medium probability trade from an area inside of triggers. That's how it works every time. What does the large chart say? It says I have momentum with the potential to break. Because it's not a clear path, I know that if I choose to enter at an area inside of triggers, I may have to manage assertively. It's not a high probability trade. If I reach the next area before I get an entry, that trade's off the table. Guys, that is exactly what we've talked about for the last hour. So I'm going to scroll up to the top of the room, and we're going to see what's going on in the wonderful world of you. And Wayne's not in here today, but he gave us one yesterday. This is Trina. Trina is day one with the software. And Wayne posted, he goes, this was Trina's chart read. And I want you guys to see how easy this can be if you allow it to be. Trina said, check it out. Strong bottom because the triggers didn't break. Odds favorable momentum because the scissors are open. I love it when you guys use that one. Clear path. Smalls and large above. She even drew an arrow. Room to the target. Yep. Look for a pullback to entry on small chart. Perfect large chart look. Do you guys see it? That is everything that we talked about in an hour, and she put it into play yesterday afternoon and was able to identify it. She kept it simple. She kept it focused. She read it and didn't overanalyze. Guys, that's how you get to where you want to be. Trina, if you watch this video, awesome job. Next one in the room. Let's see what we have. Strong bottom, odds favorable, clear path. Missed the first pullback to the area inside of triggers. And then on the second one, gets in just above. Bought a market order. Mid-band in between triggers. Learn that this is a momentum trade. So momentum trades apply. I disagree. It is not a momentum trade. It's a trend trade. 100%. Stop 2 ticks below the reversal bar. This is a trend trade. So Wayne, if you're watching this over the weekend, odds favorable, clear path, pull back to an area inside of favorable large triggers. Not a momentum trade. This is a trend trade. Fits all the rules. A momentum trade would have been from small triggers breaking above this area and getting a little snap back to it. So guys, when you know what kind of trade you're in, you know how to manage it. But this is absolutely beautiful. Everything that we look for. All right, Bob, be the man. You are earning that moniker, Bob. Weak bottom. Bob's talking about where he's coming from. Bob says, you know, I know that the high probability trend trade is a little more likely to win if I come from a strong bottom, but that doesn't stop things if it's a weak bottom. So let me always talk about where I'm coming from. Then he says, check it out. Odds favorable momentum. Potential to break. Clear path here after 1-to-1s to fib. Is there, Bob? Here's your large triggers. Here's your small triggers. What I want you to understand is that it's not a clear path after the 1-to-1s. This fib has the potential to break, guys. These 1-to-1s have the potential to break. Bob, are you in here? Does that make sense? An area isn't broken until the small and large triggers are above it. So do you see how this is a medium probability scenario, not a high probability scenario? Might need to be managed if something changes. That's all it is. I just want you to be able to recognize that. They come down and man, they missed your area by like 2 ticks. That mid band was a little low and you're like, damn it, I didn't get an entry. And then Bob said, well, wait a minute. This look says we're likely to go up. We have the potential to go up. This is all the momentum in the world. He said, I'll take this trade. I'll manage my risk. And if something changes, I'll get out. And nothing changed. And you took it all the way up to the fibs. Great trade, Bob. And the only reason I point out that it's medium probability is because maybe if that divergence pushed it down, you would know to get out instead of hoping for a miracle. Great trading, dude. Nicely done. And I told you guys, there's a gentleman in here whose whole trading plan revolves around momentum and path. Price clears trouble, market moving slow. Everything says down with nothing in the way, and Ron finds a way to get base hits. This is called the chili dog trade. This is not a Nexgen trade. This is a trade that Ron C. developed, perfected, wrote rules for, and committed to based on his ability reading the indicators. And I'm starting to see a bunch of you guys in this room start to follow it. So not bad, right? You could have just taken the trend trade up here and rode that bad boy all the way down. Ron just does it a little different way. It's not right or wrong, guys. You just have to do what works for you. And that works for Ron. And it works really well. Nicely done, Ron. All right, Pete, let's see what you have going on. Get rid of some of these. All right. Pete says, I'm coming from a strong top because price reached resistance and it created a reversal. And he said, I've got odds favorable momentum because the smalls and the large are separated, the scissors are open. And he says, check it out. This is one of those 50-50 trades, one of those potential to break, but because it's a strong top, because of that level of momentum, I feel good about it, and I'm going to enter the market right at a mid-band, right in the retracement zone. Takes the first 3 off for quick profits, takes the second 3 off, right at a potential bounce point on the large chart where the market was likely to go. Pete, this is absolutely picture perfect 50-50 trading. And everything starts with the large chart, guys. Where is it coming from? What are the advantages? Oh, they're there? Let me find an entry. And I mean, just outstanding, Pete. Great job. And then week top. So, I love this lesson. Pete, are you ready for a little mind-blowing? I want to show you guys something. Whoops. When I go to termination conditions, guys, the large chart midband behaves as a termination condition if the large triggers remain a full bar away. Do you guys remember when I said price tends to return to the large triggers? Pete got to the midband and the large triggers were a full bar away. So Pete, that's a termination condition. That termination condition reversed the market. Could we call that a strong top? Because the language doesn't say that it has to be a fib or a divergence high or low or one-to-ones. Guys, that is a termination condition that reversed the market. I love it, Pete. You had even more going for it. Everything says down. And it looks like you were getting in with the potential to break once again. Pull back to the areas inside of triggers. You chose not to take that one. You said, I'll catch it when it's on its way down. I'll get off at the Fibonacci area. And then I was looking for the next fib, but since it lost momentum, I took an exit. I love it. Pete, once again, great trading. There it is all together. It just didn't quite hit the target. So he said, you know what? I'm so stinking good at this. Let me get paid. I'll find another way in. The only thing I can say about this, Pete, is you probably could have taken that pullback right there. Strong top, beginning of momentum. You're below everything and pulling back. You just got it on the second leg. Absolutely perfect, dude. Nice job. Get paid. Why are we doing this? We're doing this to get paid. I don't ever wake up and say, man, I sure hope I don't make any money today. I always want to make money. That's the goal. Andy, large chart. Anything can happen triggers with absolutely nothing in the way. And you say, check it out. I can take a shot at it. And then I can manage it. And then I can get out of trouble. Great job, Andy. Money, money. Large chart says we are screaming to the next area. Nothing in the way. You just wait and find your entry over here. Really well done. All right, Pete. Not a trade for new users. Uh-oh. Let's see what he did. There's another one of those mid-bands as a termination condition. So this is a mid-band play on the large chart. Triggers say up, but I saw a down move if it cleared that fib. Yeah, and you had room to get to trouble off the termination condition. Small triggers rolled. And you do have odds favorable momentum here. and you just grab quick profits, and you're absolutely right. That's not a new user trade because it fights trend. And technically it fights momentum. But one of the things that Pete knows, and guys, this is why we define strong tops and bottoms. So, Kurt, let's go through it. Before his trade, where's the market coming from? A strong bottom or a weak bottom? I'm going to show you guys how chart reading is going to work its way into your day. So from a weak bottom, even with divergence, that mid-band's typically where I expect it to go first, and this is the most likely spot for a bounce. Does that make sense? They didn't make the fibs. The large crowd knows where the fibs are. So from a weak bottom, he makes it all the way to the mid-band, to the freaking tick. Do you notice that the large triggers didn't follow? So once again, termination condition gets back below the fibs, and one of the patterns that happens, Kurt, and it's not mandatory, is from a weak bottom when the mid-band holds, very often they're looking for that next key area, that key Fibonacci area. And let's see if we can find a real-world example of it. Well, that's it right there, weak bottom. That's the one that he just showed us. So let's see if we can find another example. Weak bottom, pushes up, goes to the next area. No, I don't ever ignore divergence. That would be irresponsible. Weak top, mid-band holds, pushes back up. Weak bottom, mid-band holds, pushes back down. So what he did is he took a chance. He said, because of a weak bottom, I never ignore divergence in any instance, ever. But he didn't trade into divergence. He traded to divergence. Does that make sense? He said, because of this weak bottom, because of that termination, because everything's rolling, he got in up here, below the fib, and he got out a tick or two below divergence before he gets to the fib. So he's saying, I expect him to go to 28. I'm going to get out somewhere between 28 and 37 because this is trouble. And notice that his small chart has odds favorable momentum. That's really kind of the only thing from a momentum indicator he has going for him. This is taking advantage of the gap and understanding bad bottoms and letting your chart read supersede rules, I think, but not necessarily as a negative. Is that fair, Pete? Your ability to read charts made this a trade you were willing to take a shot on? There you go. Guys, that's where we're all headed. But until you get to that point where these patterns just jump off the page at you, it's an advanced trade. It's a great chart read that he was able to take advantage of. And it's really well done. Not high probability. Hell, it's not even medium probability. It fights everything. It's a chart read. He's willing to take a chance. And guys, I'm going to tell you something. When you trade like this, and you trade like this, and you get paid on trades as often as Pete gets paid on trades, every now and then, you can take a low risk shot and not feel bad if you give up $300 or $400 because you've already made 15, 17. Does that make sense? Experienced traders, when they've got a pretty good cushion, sometimes they go to their chart reads. And Pete, you did it masterfully. All right, Miss Jen. Odds favorable, 50-50. And this is where you have to make a decision on whether or not that's a strong bottom, because it didn't really reach the area, and all of the triggers broke through the previous and the divergence low. Does that make sense? We're not quite to that key area, and you have to make a judgment call. So if my small chart had like 3 divergences, I might say, all right, that's as far as they were going. but you've got the best momentum ever. The mid-band is not behaving as a termination condition. That's okay. Sometimes you have to make a judgment call. Horseshoes and hand grenades. It pulls right back to support, right inside of triggers. You refuse to fight those small triggers. And you get in on the business side. And you carry it right up to where trouble could be. And you get paid. And then you may have given just a little bit much back on that one. See how your triggers start splitting? See how it's still 50-50? Divergence on a 50-50. That was your second divergence on a 50-50. Your third divergence is where you exited. This was your small chart telling you things aren't great. And I won't try to impose my will on you, Jen. One divergence on a 50-50, especially from a strong bottom, I'll tend to ignore it. Two divergences for me is a 100% deal breaker. Because at that point, not only do I not have a clear path, my small chart's trying to tell me change is coming. My small chart's trying to let me know that the sellers aren't cool with that forward progress. I made 50 bucks. That's all right. It's better to make 50 than to lose 50, right? And there's a great lesson. Knowing what kind of trade you're getting into lets you know how you need to manage it. And you're giving back almost $100. That's a tough look, though, because once you get in, you're pretty far away. But everything's going the right direction. I just think, for me on a 50-50, I'm getting paid for sure, and I'm not risking a lot if something changes. Great trade, though. You did it well. And you took a trade that failed and made money on it. That's great chart reading. There's a strong top. There's odds favorable momentum. You didn't take it on the 50-50. And then as it's coming back down, you get in, get out at fibs, get out at the next fibs. All right, I like it. Different kind of look, for sure. Worked out. And then the same look, strong top, 50-50, didn't take the entry at the areas, chose to get in on the way down, no worries, you got momentum on everything, out at trouble, and then predetermined second target, nicely done. And Jen, just for the sake of discussion, there's one of those pull back to the areas, small triggers a full bar away, and NASDAQ moves fast. I'm impressed. Of course I will. I could stop if you like. I don't mind stopping. Okay. NASDAQ is fast. But I think, and again, I love to celebrate victories. If you had entered right here, Jim, nothing says you're in the wrong trade. If anything, it just got better for you, right? If I entered right here, I'm ecstatic right here. And my expectation is the fib. So it's all right. You're getting into the trade with the expectation of the fib. I think it's beautiful. Nice job. Good morning, Miss Cindy. All right, Pete again. Rinse and repeat. The exact same look. Termination, things are rolling. The big difference between this one, Pete, is now you're coming from a termination condition. Huge difference. Huge difference. Taking this trade from a termination and taking this trade from a weak bottom. Because on this one, these triggers are more likely to hold. And on this one, you didn't have odds favorable momentum down. And you might have pulled one over on them this time, Pete. Does that make sense? if we look at your last, you say rinse and repeat, but it's not the same trade. This one is from a bad bottom. Your large triggers have rolled. You have odds favorable momentum. This one is coming from a termination. All your indicators are up and your smalls are above. Huge different look. I love the first one. This one, I think you got lucky. I think that you pulled one over, because from this pivot stop out at support, this thing's more likely to rocket up off those triggers than it is to break down and retest. So this one required some patience, turbulence, target. I'm glad you got paid. I'm always glad when you guys get paid. But I'm not afraid to point out that it's not the same trade, that it's very different patterns. Absolutely, I will too. I was having a talk with someone. We're having a little discussion offline. And they showed me two trades. And they say, well, this is the same trade. So Pete, this isn't necessarily for you. This is a conversation that I had that I want to share. And they were the same thought process. One of them was trading with triggers. One of them was trading against triggers. One of them was trading when the market was on its way up. One of them was going with the market on its way down. And there were two hugely different scenarios. But it was the same style trade, very much like you just presented, Pete. And the conversation that I had, and I hope this is valuable and not at all, I don't know, offensive, whatever, is that rules are patterns that have been proven to win more than they lose. Does that make sense? That's what rules are. Rules are essentially patterns that have been proven to win more than they lose. So if the patterns are completely different, maybe there should be different expectations. And you sat through it. And your exit, I'm assuming, was maybe 5 or 6 ticks above that fib, saying, all right, if the fib doesn't hold, they're going to get me, we're probably going up. Just knowing what you're getting into, understanding the pattern that you're trading, lets you know how you should be managing the pattern. I think it's a great trade. I like the first one better, but it doesn't matter what I like, because I probably like my wife more than I like your wife, and that's okay. That's probably a good thing. Great trading. All right, Steve Diego, strong top. Man, Steve, are you in here? I don't know if I can call this a strong top. Price reached resistance. Small triggers got through. And Steve, you're thinking, but the small triggers didn't get through the next area, right? But price never reached that next area, which means that it can't be a termination. This is one of those ones that are going to make you think. So your 57 fib had the potential to break because the small smashed through. Your 62 fib never made it into the equation. It never became a termination. So I might call that a weak top. That's an interesting look. You don't see that very often. That's one of those ones that make you go back to the words. What is a termination condition? Price reaches, triggers don't break. Half of that equation isn't there on 62. I saw this one, I was like, oh, that's pretty cool. But this is very much the same thing that Pete did, right? There's your termination. The triggers are headed down. Small triggers are headed down fast. And you said, once my small chart gives me that momentum, I'll look for an opportunity. I'll take that momentum style trade and I'll make quick profits. And you did it beautifully. You came from a termination condition on the large chart. You let the small chart dictate the change, and you caught that momentum on the way down. I mean, it's a gorgeous trade, Steve. And the fact that I'm not calling this a strong top has nothing to do with anything on how well this was done. Small triggers are screaming, odds favorable, and this is just the Nexgen momentum trade. 27 seconds. Really well done. Heads up. I like it. Strong top. Perfect. Let it clear the fibs. Beautiful. Find a way to enter. You did trade into the one-to-ones, but it did work out for you this time. On these momentum style trades, guys, you're trading from the area, not to the area. There's a big difference. And if you're going to take a momentum style trade, I hate to be a nitpicker, you should probably have momentum on both charts. Otherwise, it's kind of like vegan bacon, right? You can call it bacon all you want, but it's not. You can call it a momentum trade all you want, but it's not. Does that make sense, Steve? You're letting the large chart lead the way. And as long as you know that trading directly into those one-to-ones could create an ugly bounce all the way back up here, you did it wonderfully. Morgan, 2 for 1. What does that mean? Let's see. Strong bottom, no triggers through. There's your reversal. There's odds favorable. You take the jump in, and it doesn't work. And then you go to take the trend trade, and it didn't work. No divergence on the 50-50. Yeah, that's a tough one, Morgan. And I'm trying to see if there's anything I can give you here. Because those were probably wide on the way up. That's okay. It happens some days. Yeah. I mean, it fit the rules for the chili dog. And it fit the rules for the trend trade. The only thing that I could say, Morgan, and I don't know, is because the triggers are split, you could wait for a confirmation bar, but you really didn't need one. It just didn't work, man. That's a bummer when it's 2 in a row, isn't it? Been there, done that. Doesn't mean that your plan is wrong, though. It doesn't mean that your plan is wrong. It doesn't mean that your rules aren't right. It just means, man. Some days you're the boot and some days you're the butt, right? Needed the humbling. I feel that way sometimes. Jen, strong bottom. Absolutely. Can we talk about how Jen defined this strong bottom? Because it was a weak bottom here, right? Never did a squat in its life. And then it came all the way up to the mid-band. Price tends to return to the large triggers. So when it reached Fibonacci support, the triggers had already rolled, but I have a termination condition, no triggers through, changing the direction. Chef. I love it, Jen. And then you get that odds favorable momentum. And it pulls back right to those flat triggers. So you're trading from down here. You've got it circled up here, but you're trading off the bottom here. On the pullback to the areas right at the synthetic where the gap was closed. And you get in on the way up on the good side of the triggers, make your money. And then the one that you have circled was this trade right here. And that termination condition stopped it. That's okay. You let it all roll. You got it on the right side. It's a little different look. So this trade was into the termination, and it looks like the termination worked. 3 divergences. I love this trade. I always see them. It's annoying how I see everything, isn't it? What I do, guys, when I look at your charts and I look at your entries, your synthetic triggers are a big tell. See how they're flat and they just rolled? That happened right here. So what this is, it's maybe, I mean, you still have momentum and you have a clear path, don't you? And you did get a pullback and you refuse to fight the triggers, which I love. And you're a little late. Why did you wait for price to clear the mid band? Did you make up a rule? Did you add that one? Made it up. That's okay. Friday makeup. That's okay. It's all right. Making up's fun. It's funny though because this mid-band was a termination and you didn't mind trading back to it. That's just a little squiggly average. You're good though. You had the right idea. Everything was going. I love it. Everything's set up. And you went up. Yeah. Isn't it crazy, Jen, how the simple task of never fighting those triggers helps so much on the NASDAQ? I realize that like more and more all the time. Don't fight, don't fight, don't fight. Great trade. I like everything about the trade. I even like that you didn't know where it came from when you annotated. And then the smalls on the large chart. Let the large chart lead the way. Just find an entry. Joel, odds favorable. Separation of small and large, open like scissors. That is one of the best descriptions you could ever give me. Clear path, room to the target. Love that large chart. Pull back to an area inside of triggers. And let's ride that mofo down. You had the mid band. You got in just at the top. You got in at the large chart mid band. Worked out. Nice job, Joel. Large chart leads the way. And then Pete, I'm ignoring those two. Is that right? You know I got to click on them anyway. Just because. That one didn't work. That one did though. Your second one did. Momentum, potential to break, 710, 710. Boy, that's not a lot of room, but you pulled it off. That is having virtually no room to the termination condition, but because of the momentum everywhere, you're like, hey, hold it. I'll take that little momentum trade to hit the fib. That's actually a beautiful trade. It's tight, Pete, but that's a nice looking, it's a momentum style trade. Momentum, potential to break, snap back, boom, out of trouble. I mean, that's solid execution. You know I don't care about the money. You have yet to buy me anything pretty, guys. Your money means nothing to me. Your execution excites the hell out of me, though. That is a textbook momentum trade, relying on the snapback to the one-to-one. And it's not a lot of room, but man, that is nice. Really well done, Pete. Glad I didn't ignore both of them. Morgan. There we go. No longer the butt, my friend. You moved into Bootsville. Everything says down with nothing in the way, and you said, you're damn right, I'm getting paid. Nicely done. Great trade, Morgan. You let it clear. Everything says down. Path is clear. And you said, I know it's just a momentum trade. Let me get paid. Nicely done, dude. Oh, and he gave you a chili dog. You needed that one, right? You stuck to your plan even after 2 losers. How cool is that? That's trust. That's trust. I just took 2 losers, but my rules are met. I'm going to take the trade. That's not always easy. Potential to break. Here's your pullback, but it was divergence. Divergence is a big killer. And sure enough, it looks like it's not going to break. Not yet. Smalls got through, large didn't. Not a strong bottom. Directly into the midband and Fibonacci. There's your termination condition. This was a bad bottom and the market continued to the next fib. This is a bad bottom. I wonder. I guess we'll have to see what happens after the retracement zone, huh? Can't really predict. Guys, that's all the pictures. Which means the burden of education falls upon you. Did I miss your chef? Man, I already said nice things about you today. Why do I have to do it again? Sorry. Let's check it out. Why is that not the best top? Chef? You can't put that's not the best. Okay, hold on. This didn't look like the best top, but I had odds favorable momentum with a clear path. I set a sell order on the pullback, but it was one tick above the spot that I began to come back down. I went in late, but held for a complete trade to my target. Overall, not a bad trade, not a bad day. About an hour's worth of watching ES. All right, so couple things, Chef. Actually, there's a lot of lessons on this one. Are you ready? Price reached Fibonacci resistance, a divergence high in the 1-to-1s. Every trigger line stayed below it, and it reversed the market. Chef, that is the sexiest strong top you could ever have. That is multiple termination conditions that reverse the market. Does that make sense? I don't know why you didn't feel like it was the best top. And if you don't mind typing, I'd love to hear what turned you off about that top, because I think there's a great lesson here. And I'm going to show you guys. Has nothing to do with it. So actually, Chef, when those moving averages can't even get close to the fib, it's even better. Look at it right there. It's the closer they get and the more they hug it, right? But this is, price whipped up so freaking fast and stopped cold that the triggers couldn't even catch up. That's awesome. That's a great top. And then you had odds favorable momentum. You had a clear path. All right, Chef, I'm going to get you on this one. No more playing favorites, man. You ready? Awesome. That's why we post in the room. I'm telling you, Chef, I've misunderstood every lesson at least 10 times, and my brothers had to repeat it and clarify, including this one. But John, the triggers didn't make it. I'm telling you, I've had the exact same conversation with my brother, and my brother goes, well, that's great. They couldn't even get close to it. They couldn't even come close to breaking it. So I love that one. All right, Chef. Here's where we're going to have a little talk. For 5 years, I've been teaching this entry. And for 5 years, the entry has been defined as a couple ticks below the area that you anticipate to hold. Why? Because this line is where we expect the bounce, right, Chef? 100%. That line is where we expect the bounce. Why would I put an entry on the wrong side of the bounce point? That's like, Chef, me going, hey, kick me the soccer ball. Kick that soccer ball to me. But I'm going to go stand behind this wall. I sure hope it gets there. Does that make sense? So if you're up here and that's supposed to hold it, you end up getting in late. And that's a big difference. That's the difference between 0.5 and 275. That's like a 2 points. That's a huge difference on this trade. So one of the reasons that entries go a couple ticks below is because we expect the bounce from that area. And these moving averages, as this price comes up, Chef, it'll come down and you might have to readjust. And that might be what got you too. Because I've put my entry at the order, and that mid band comes up while this price comes down, and then they flatten out when they hit. So if I put my limit order in and that mid band's going up, I may have to click it and adjust it a couple times. Of course, nobody went long here, right? Because it was a termination condition. Because price reached resistance. Does that make sense, Chef? Your large chart is absolutely gorgeous. Everything about it. Little stumble here. And then look at this. This is a great example. Oh, I like this. So check it out. A tick below the area. It never made it above it, did it? Would have been the same scenario if you were entering on the second entry. That's pretty cool. That's why we go in a tick or two below. Nothing wrong with that. Because, Chef, you had this look. There was no reason to exit with a second divergence, so there's no contracts to add on. I love it. But do you see how it stopped a tick or two below? They know where these areas are, guys. These prices aren't just for Nexgen users. All of these areas are a reflection of the psychology, of the fear, of the greed. We just know where they are and have a plan to trade them. It's pretty awesome. How amazing. All right, guys. I'm going to take my second break. I'm a big fan of stretching legs. Walk away. Chef, did I answer everything you needed answered on that? I mean, you're up a grand. That's amazing. But I think there's a couple great lessons in there, for sure. No negatives, not one negative, just a little, hey, let me push you towards not missing those entries. So, guys, I'm going to go walk a lap real quick. I firmly believe nobody should sit in front of a computer for 10 hours straight. So go stretch your legs, refill your water, pet your dog. I'll be back in probably 3 or 4 minutes, and then we'll get into the last hour, and we'll go through. And one of the things, if you guys want me to, let me know. Before the hour is up, if you want me to go through how to activate and set up market replay so you guys can get some study done over the weekend, let me know. I love to do that on a Friday for you. I'll be back in just a couple minutes, guys. Talk amongst yourselves. Post them if you got them. All right, y'all, let's get into it. Last hour. No pictures, no questions. What do you guys want to talk about? What can I do for you? What you wondering? Nobody. All right, so let's see. Price reaches resistance, creates what could be deemed an untradeable bounce off the midband, closes the gap to the triggers, decides to head up directly into a termination condition where it appears to have rocketed through all the areas inside of favorable large triggers. Don't have rules met. And this bad boy just keeps pushing down. So, all right. This is where I just start going through the pictures that I have for you guys, and that's okay. You got it, Joel. So NASDAQ traders. Let me find it. You're fine, Joel. The speed of the NASDAQ is difficult, guys. I'm not going to lie. But there's two things. The first thing is that the rules are met. Can't stress that enough. Especially on the NASDAQ, guys. If you are bypassing, sidestepping, avoiding large chart rules being met, you're going to be less likely to win. It's just the way the NASDAQ works. It already overruns areas and stuff like that. So when I reach the area, if the large chart rules are 100%, Joel, and price is pulling back to the area inside of favorable large triggers, there's two looks that your small triggers are going to have on the NASDAQ. One of them is where they're going to be below the reversal bar marker or even straddling the reversal bar marker. They're not a full bar away. When that happens, the highest chance of success comes from waiting for a close on the correct side, because those triggers are very likely to behave as resistance. Not waiting for a reversal bar, waiting for a close on the correct side. If the rules are met on the large chart and price pulls back to the area inside of favorable large triggers, and my small triggers are above the reversal bar marker, they're a full bar away, enter at the area. You have time to manage if they become resistance. So when I say correct side, these triggers are going down. We want to go up, right, Joel? So anything over here is the downside. Anything over here on the correct side is the upside. So I want to be on the upside of those triggers, not the downside of those triggers. That's what I mean when I say the correct side. I want to be on the side where the triggers are in my rear view mirror, not trading with those triggers coming at me like a charging rhino. Does that make sense? There you go. And then it's just a matter of practice because the NASDAQ is fast. The NASDAQ is so fast. Termination for the win. Once again. I personally, I don't care for trading the NASDAQ right off the open. It's too fast for me. So guys, these are the Nexgen trades. This is essentially everything that you're doing. Define your termination condition to be true. Let the market reverse. If it reverses from the termination condition, Nexgen teaches a trade called the HVA trade. It requires a second chart. It requires a strong top or a strong bottom. There's a couple different things that have to happen to make that trade work. It's a little more advanced, but every lesson that you take from the high probability trend trade will set you up to be able to take the HVA trade. From the HVA trade, If you have strong triggers on both charts, if there's nothing in the way, you're going to look for the trend trade. That's all it is. And you're going to keep trend trading until you hit the next area. And when you hit the next area, it all starts over. And guys, it's rinse and repeat, like Pete said earlier. Hit an area, let it roll, look for the trend trade. Everything's strong, take a trend trade. If the area holds, look for the HVA trade. If the area breaks, look for the next trend trade. I did a little more advanced version of that. And I just saved it. 1 second. So when the termination condition holds, as you grow with the software, there's more and more opportunities. I hope that I've said that. As you grow with the software, there are more and more opportunities. So once the termination condition holds, your first opportunity is that white chart breakout trade that John Novak used to teach. He used to do private classrooms and teach people this trade. And all it is it's the first shot off a termination. The second shot is the HVA trade. The third shot is the Nexgen momentum trade. The fourth shot is typically the trend trade. And this is what everybody learns first, because the trend trade is trading from an area and it's trading to an area. And that's the highest chance of success for new users. And then there's that Nexgen user, that chili dog trade that shows up when everything is screaming and there's nothing in the way. So just if you guys wanted this one, understand that we start with a trend trade, but that trend trade and what you learn from it opens the doors for the rest of the trades. It really does. It sets you up for more and more. There's your termination. The triggers don't agree. And I want you guys to see something. Decisions are made at key areas. We'll just use this little snippet. And I think this is cool. And I hope you guys do. There's a decision being made right at a divergence low. That decision was to push up. There's a decision as you get back into it. You can see the tail. You can see the tail right at the fibs. You can see the tail right at the fibs. And notice that price gets below and above and back below right at the fib. Decision at the fib. Price splits the fib. Decision making, decision making, decision making. Guys, decisions are made at key areas. Did you notice that there's no tails between there and there? When it gets past it, before it gets to it, kind of in between the areas. That's the easiest trading areas. So, what do you guys want to talk about? Should I just go mic silence? I can. I don't mind. You guys want to hear me type? I can do that. Anybody have plans for the weekend? Morgan. Gonna sleep, thaw out. I like it. I like it. I'm about... John Novak's sister-in-law is driving up from Houston. We're going to tattoo her today. That should be fun. It's not momentum. Because she very intelligently said, I don't want to work overnight. So she took a position as a case manager during the day. So Nexgen Jen is out saving the world during the day. So she doesn't get to be in the classroom. Yeah, I saw that. Detroit flooded and froze. There you go, Ron. That's for you. We did a pirate ship for you. Fun stuff. Thanks. Yeah, that picture was wild, Morgan. Like the cars frozen in the floodwater. I'd never seen anything like that. That was so weird. Pretty cool though. Can't even have a front yard in Detroit anymore. I don't know what that means. Guys, the S&P has no idea what it's doing. Crude oil keeps pushing down, but it's starting to slow down. No more news coming. Oh, but you can't have anything in Detroit. I got it. No one lets me in on the running jokes. I'm not that cool. That's funny, Ron. They put a VW in the middle of the frozen river where to place bets on what day it would fall in. Did you bet on it? Did you win? All right, guys. A couple gifts for the weekend. 7 Habits of Highly Successful Traders. Awesome read. Emotion-Free Trading. Awesome read. Might have done a little ice shifting. I'd be afraid I'd fall in with it. I don't know why. The idea of falling through ice terrifies me. I've got a buddy in Minnesota. He's like, come ice fishing. I'm like, no. I'm not going out on the ice. What if it breaks? I've seen movies. When you live in Texas, the thickest the ice gets is about a 32nd of an inch. So there is no walking on ice. It's going to be an early day, isn't it, guys? Did you have a good week? Did you learn anything? Just a step on ice? Yeah, it's... Crude hasn't moved. Look at that timestamp. 11:04, 11:01. We're getting about a bar every 30 seconds on the small chart. In the S&P, that's their line in the sand. That's the line in the sand. We'll see if they go up or down from there. There's a definite fight, right? Right at those key areas too. Isn't that awesome? You guys know about these areas. You know where they are. You have a plan not to trade into them. I guess that's the coolest thing, is that we've got plans in place to keep us out of that trouble. NASDAQ is still moving. Well, let's do a chart read on the NASDAQ then. You know, I had someone ask me, hey Mark, why don't you call trade? Why don't you take trades in the live market? And guys, every time the rules are met, have you noticed if we're watching it, I take the trade? And new users always want to see me trade. I want to see Mark trade. I want to see Mark trade. Guys, me trading isn't going to help you because I'm going to trade when the rules are met. And if the rules are met, it means that I can't fabricate a trade to show you what a live trade looks like. Every now and then I've done this where I take the wrong trades and say, hey, we're taking the wrong trade. Let's see what happens. And we get run over, and then I get a message saying, well, Mark's taking losers in the room. So it's just gotten better not to do it. Price reaches Fibonacci support. Large triggers a full bar away. It closed the gap. Odds favorable, momentum, potential to break. They're doing a little snapback. Yeah, NASDAQ's moving, huh? Two divergences on a 50-50 trade. That doesn't sound like a good plan. Here we go. Let's do this picture. We've done it 4 times this week. Let's do it again. This is the NASDAQ currently as we speak. And then, guys, this is... let me go back. You know you've been doing this a while where you know where every picture is located. Resistance, back to support, triggers don't follow, back up to the area. Resistance, back to support, triggers don't follow, back to the area. And look what's happening. The same thing that happened in the picture from 2001. Patterns repeat themselves over and over and over. Is there anybody in here on demo right now? Guys, do I have any demo people? People evaluating the software, trying to figure out if it's right for them. So when it gets this quiet, I really want to lean on my demo people and see if there's something I can do for you. Junior, I see you made it back in. Good to see you. Did you read that little paper on trend trades that I gave you? I hope that was helpful. Go through and look at your pictures. Ron's a motorcycle man. Andy looks happy to be here. Morgan's been working out. Miss Cindy looks like the cover model. Greg GB looks like you're surfing. I can't tell if that's what it is. Always fun to see what you guys look like. 3 divergences in the same location. Price didn't work. You are surfing, Greg? Man. I keep telling my wife we need to take a surf vacation. I haven't surfed in 30 years, but I used to love it. One day. Great beaches when they're not covered in snow. You know, Morgan, I didn't notice an influx this year at all. Yeah, but Australia has all those big sharks, Jen. Aussies are tougher than me. I figure if it's your time, it's your time, right? All right, Steve, let's see what you did. On the NASDAQ, everything says up directly into a potential termination condition without momentum. Not a lot of room to the target, but it works out, right? So Steve, once again, right at the pink line without momentum. And you were letting it clear trouble down here, but you reached trouble up here. And I'm not knocking your trade. It's your trade. That market's railing. In and out on the same bar. $12.50, $14.50, $15, $14.50, yeah. Right on. Things you can do on the NASDAQ, I suppose, huh? Get that quick in, quick out, make a little money on the way up. Nice job, Steve. A little hard to see until I zoomed it in, but yep, you're in before trouble. And you are out before trouble. Nicely done, man. Jen, when you were growing up, you had a motorboat. You used binoculars to ensure no sharks in the bay when you were going skiing. Now, how do binoculars help you see under the water? Is the water that clear that you can see sharks? There's a lot of blacktip reef sharks. Okay. Down in the Gulf, there's a lot of blacktip reef sharks, and they used to come by. You'd see those. You'd sit on your board, and they would swim by, but they just didn't mess with you. We didn't worry about them so much. Well, the white shark, you can hear the cello playing, right? The da-da-da-da, so you know to get out of the water. I like that they have a soundtrack. I almost think that the saltwater crocodiles are scarier than the sharks down there. Yeah, that makes sense. And I like that you call them motorboats. I'm not sure what else you would ski behind. Unless it's really windy. Then maybe a sailboat. Yeah, we've got hammerheads down in the Gulf too. Sharks, I mean, my gosh, they don't care about us. I just think sometimes we look delicious and they don't realize we're not a meal, right? Gulf of America. Poking the bear. Poking the bear. All right, guys. Over the weekend, if you want to study, Market Replay allows you to go back and replay every day of the week. So if you got 5 days worth of experience this week, guys, you can go back and get another 5 days worth of experience. You can go back, you can download it, you can replay it, you can fix mistakes, you can work on management. Jen, you could go practice timing entries. Joel, you could go practice timing entries on that NASDAQ because it's so darn fast. I did that because entries are hard when the NASDAQ is moving. It works now. Was it the dates? There you go. Thank goodness you didn't ask me in the room to help you with that. You just waited until I did a market replay day. Did I tell you no? Oh my gosh, I'm sorry. I always try to be helpful. My computer just choked. I think my new computer I could load multiple days and be okay. You could launch a space shuttle with the computer I have now. All right, guys, I'm going to